Imagine owning a piece of Apple, Microsoft, Amazon, Google, and literally every major company on Earth. Now imagine that slice being worth $1.5 trillion. That's trillion with a T, enough money to buy Disney, Netflix, and Tesla combined, and still have 500 billion left over. But here's what nobody knows. This isn't owned by some mysterious billionaire or shadowy investment firm. It's owned by Norway. All of it. While you've been watching Elon Musk and Jeff Bezos battle for the title of world's richest person, an entire country has been quietly building the largest sovereign wealth fund in human history. They own 1.5% of every publicly traded stock on the planet. They're the largest single shareholder in over 9,000 companies across 70 countries. When they speak, markets move. When they divest, entire industries tremble. But what nobody talks about is how a country with just 5 million people, fewer than Los Angeles, built this financial empire. The secret weapon they used, the controversial choices they made, and why they're now more powerful than most nations' entire economies. This isn't just about money. This is about a small Nordic country that discovered something in the North Sea that would change everything. Something that turned fishermen into some of the richest people on Earth. Something that created a fund so massive it could theoretically give every Norwegian citizen $280,000 in cash and still have money left over. But behind this unprecedented wealth lies a darker question. Is it ethical to build paradise on oil money while the world burns from climate change? And what happens when a single fund becomes so powerful it can reshape global capitalism itself? This is the story of how Norway cracked the code to generational wealth, built a financial war machine that operates in the shadows, and created what might be the most successful investment strategy in human history. Welcome to the secret empire hiding in plain sight. Today, Norway's government pension fund Global sits on $1.5 trillion. To put that in perspective, that's larger than the GDP of Canada, Russia, or South Korea. It's more money than Apple, Microsoft, and Saudi Aramco are worth combined. Every single Norwegian citizen, from newborn babies to centenarians, theoretically owns $280,000 of this fund. But rewind to 1969, and Norway was nothing special economically. It was a cold, sparsely populated country on the edge of Europe, known for fishing, farming, and not much else. The average Norwegian made less than someone from Kentucky. The country imported most of its energy. Young people were leaving in droves for better opportunities in America and elsewhere. Then everything changed with a single discovery in the North Sea. What most people don't know is that Norway almost missed out entirely on what would become the foundation of their wealth. When oil was first discovered in the North Sea in the 1960s, Norway was just a bystander watching Britain and Denmark stake their claims. The Norwegian government was actually reluctant to get involved in oil exploration, worried about the environmental impact and the boom-bust cycles they'd seen destroy other resource-rich nations. Behind the scenes, a small group of Norwegian politicians and economists were crafting something unprecedented, a plan to avoid the resource curse that had plagued every oil-rich nation before them. While countries like Venezuela, Nigeria, and Saudi Arabia spent their oil wealth on immediate consumption, luxury, and often corruption, Norway was designing something radically different. The key insight came from a 26-year-old economist named Farouk al-Qasim, an Iraqi petroleum geologist who had fled his homeland and somehow ended up in the frozen fjords of Norway. This man, who spoke broken Norwegian and lived in a tiny apartment in Stavanger, would become the architect of the most successful resource management strategy in human history. But here's what's really fascinating. Norway didn't just stumble into good fortune. They systematically studied every oil-rich nation that had come before them, identified exactly where each one went wrong, and built their system to avoid those specific pitfalls. They looked at how Kuwait's wealth created a generation of entitled citizens who stopped working. They studied how Nigeria's oil revenues disappeared into corruption and civil war. They analyzed how Venezuela's politicians used oil money to buy votes and stay in power. The Norwegian solution was elegant in its simplicity. Take the oil money and invest it abroad, in foreign companies and foreign markets. Don't spend it domestically where it could create inflation and corruption. Don't let politicians touch it for their pet projects. And most controversially, Don't let the current generation spend it at all. Save it for future generations who would live in a world after oil. This wasn't just about creating wealth, this was about creating sustainable wealth that could outlast the oil reserves themselves. The Norwegians understood something that every other oil nation had missed. Oil is finite, but properly invested capital can grow forever. What they created was essentially a massive insurance policy for their entire civilization. A guarantee that when the last drop of oil was extracted from the North Sea, Norway would still be one of the richest countries on Earth. The fund they built operates with a level of transparency that would make most governments nervous. Every single investment is publicly disclosed. Every quarter, they publish detailed reports showing exactly where every $1 billion is invested. They even publish the environmental and social impact assessments of their holdings. Try finding that level of disclosure from any major American pension fund or endowment, but transparency came with a price. As the fund grew larger, Norway found itself in impossible ethical positions. How do you invest oil money responsibly when oil is destroying the planet? How do you own shares in weapons manufacturers when you're trying to promote peace? How do you profit from tobacco companies while running universal healthcare? These questions would eventually force Norway to become pioneers in something called ethical investing, a concept that barely existed when they started, but has now influenced how trillions of dollars are managed worldwide. Today, this fund doesn't just own stocks and bonds. It owns forest land in Romania, shopping centers in London, office buildings in Manhattan, and renewable energy projects across 6 continents. It's the largest real estate owner in several major cities. When you shop at a mall in Europe, stay at a hotel in Asia, or work in an office building in America, there's a good chance Norway's fund owns a piece of it. But to understand how a small Arctic nation built this financial empire, and why it might be the blueprint for how countries should manage natural resources in the 21st century, we need to go back to where it all began. To a floating oil rig in the North Sea, and a discovery that would change everything. TR Chapter 1, Black Gold. December 23, 1969, Christmas Eve morning in the North Sea. The crew of the Ocean Viking drilling platform should have been thinking about going home for the holidays. Instead, they were staring at something that would reshape the global economy. Oil. Not just a little oil, massive reserves of high-quality crude oil sitting beneath some of the most challenging waters on Earth. Phillips Petroleum, the American company running the operation, had struck what they would later call black gold. But what happened next reveals everything about why Norway succeeded, where so many other oil nations failed spectacularly. The Norwegian government could have done what every other country did: sell drilling rights to the highest bidder, pocket the immediate cash, and let foreign companies extract the wealth. Saudi Arabia did this with American companies, Nigeria did this with Shell, Venezuela did this with Exxon. In every case, most of the long-term wealth flowed out of the country, while the oil-rich nations were left with temporary revenues and permanent environmental damage. Norway chose a different path, and that choice made all the difference. The architect of this decision was a man named Jens Hundseid, Norway's Minister of Industry at the time. Hundseid was an engineer, not a politician, and he approached the oil discovery with an engineer's mindset. How do you maximize long-term output while minimizing long-term risk? Hundseid had witnessed firsthand what uncontrolled resource extraction could do to a society. His grandfather had worked in Norway's early mining boom, where foreign companies extracted vast mineral wealth while local communities saw almost none of the benefits. The companies got rich, the environment got destroyed. And when the easy-to-extract resources were gone, the companies disappeared, leaving behind economic wasteland. "We will not repeat the mistakes of our grandfathers," Hundseid told Parliament in 1970. "This oil belongs to all Norwegians, not just those alive today, but those who will be born long after the oil is gone." But declaring national ownership was the easy part. The hard part was figuring out how to actually extract and manage oil wealth without destroying Norwegian society in the process. This is where Farouk Al-Qasim enters the story. Al-Qasim was a petroleum geologist who had fled Iraq in 1968 after Saddam Hussein's Ba'ath Party came to power. He spoke virtually no Norwegian when he arrived, had no political connections, and was working odd jobs to survive. What he did have was intimate knowledge of how oil could either build or destroy a nation. In Iraq, Al-Qasim had watched as oil revenues created a massive bureaucracy, inflated the currency, and ultimately funded the very dictatorship he had fled from. He had seen how oil money corrupted politics, destroyed other industries, and created a culture of dependency where citizens expected the government to provide everything while contributing nothing. When the Norwegian government started looking for expertise on oil management, someone recommended this unknown Iraqi refugee living in a tiny apartment in Stavanger. The meeting was supposed to last 30 minutes. It went on for 4 hours. Al-Qasim didn't just explain how to extract oil, he explained how oil destroys countries. He drew diagrams showing how sudden oil wealth creates inflation that kills manufacturing. He showed historical data proving that most oil-rich nations end up poorer in the long run than countries with no oil at all. He called it the resource curse, and he had lived through it. Oil is not a blessing, Al-Qasim told the Norwegian committee. Oil is a test. Most countries fail this test. Then he outlined how Norway could pass it. The key insight was surprisingly simple. Treat oil money like inheritance money. When you inherit a fortune, you don't spend the principal. You invest it wisely and live off the returns. Norway should do the same thing with oil revenues. Take the money from oil sales, invest it in foreign assets, and only spend the investment returns. This concept became known as the bird in the hand principle. A bird in the hand, oil money invested abroad, is worth 2 birds in the bush, uncertain future oil revenues. By investing oil proceeds in global markets, Norway would be converting finite oil reserves into infinite financial assets. But the plan faced massive political resistance. Norwegian politicians wanted to use oil money immediately to build hospitals, schools, and infrastructure. Labor unions wanted oil revenues to fund generous welfare programs. Business leaders wanted subsidies and tax breaks financed by oil wealth. Al-Qasim and his allies had to convince an entire country to essentially become rich, but continue living like they were middle class. The breakthrough came when they showed Norwegian politicians what had happened to other oil-rich nations. They presented case studies of Nigeria, where oil wealth had funded civil wars, Venezuela, where oil revenues had created hyperinflation, Iran, where oil money had propped up a dictatorship. In every case, spending oil wealth domestically had created more problems than it solved. The alternative was something no country had ever attempted: systematic long-term investing of natural resource revenues. In 1972, Norway passed legislation creating Statoil, a state-owned oil company that would extract Norwegian oil under strict environmental and social guidelines. Unlike the American, British, and Dutch companies that had previously dominated North Sea oil extraction, Statoil was required to reinvest profits back into Norwegian society through the investment fund. The early years were brutal. North Sea oil extraction required technology that didn't exist. Platforms had to withstand waves that could reach 100 feet high and winds that regularly exceeded 100 miles per hour. The learning curve was steep and expensive. Several early oil rigs were destroyed by storms. Workers died in accidents. Environmental groups protested constantly. But by 1975, Norwegian oil production was reaching commercial scale. The revenues started flowing, and suddenly Norway faced the moment of truth. Would they actually follow through on their plan to save and invest the money, or would political pressure force them to spend it immediately? The temptation was enormous. Oil revenues in 1975 could have funded a 50% increase in government spending. Norway could have built the most generous welfare state in human history overnight. Politicians could have cut taxes to zero and still had money left over. Instead, they did something unprecedented in the history of natural resource extraction. They saved almost all of it. The oil money was placed in a special account at Norway's central bank, completely separate from the government's regular budget. Politicians couldn't touch it without special legislation. The money would be invested in foreign stocks, bonds, and real estate. The goal was to build a portfolio so large and diversified that it could generate returns forever, long after the last Norwegian oil well ran dry. What Norway was attempting had never been tried before by any nation. They were essentially trying to convert a finite natural resource into infinite financial wealth. The success or failure of this experiment would determine whether future generations of Norwegians would be among the richest people on Earth, or just another cautionary tale about the resource curse. By 1976, as oil revenues poured in faster than anyone had anticipated, it was clear that Norway's little experiment was about to become something much bigger than anyone had imagined. The question was, would the rest of the world notice what they were building before it was too late to stop them? Chapter 2. The Vision. The Berlin Wall had just fallen, the Soviet Union was collapsing, and the world was entering a new era of global capitalism. In the corridors of Norway's finance ministry, a small group of economists and politicians were designing something that would fundamentally alter the balance of global economic power. They were creating what would become the largest pool of investment capital in human history. The oil money had been accumulating for 15 years, but it had mostly sat in conservative government bonds and bank deposits, safe but earning modest returns. By 1990, the accumulated oil revenues had reached 25 billion, a massive sum for a country of 4 million people, but still small enough that it didn't attract much international attention. That was about to change dramatically. The visionary behind the transformation was Knut Wold, Norway's Director General of Economic Affairs. Wold was a mathematical economist who had studied at Princeton and worked at the International Monetary Fund. Unlike most government officials, he thought in decades, not election cycles, and he had become obsessed with a question that kept him awake at night. How large could Norway's oil fund grow if they played their cards perfectly? Wold's calculations were staggering. If Norway could maintain oil production for another 30 years, and if they invested the proceeds in global stock markets earning historical average returns, the fund could theoretically grow to over 500 billion by 2020. That would make Norway's investment fund larger than the GDP of most countries. But Wold wasn't satisfied with theoretical projections. He wanted to build something unprecedented, a sovereign wealth fund that could influence global markets while remaining completely transparent and ethical. A fund so large it could reshape capitalism itself. The challenge was that no one had ever tried to manage that much money on behalf of an entire nation. The largest pension funds in America managed maybe 100 billion. The biggest university endowments were under 20 billion. Norway was planning to build something 5 to 10 times larger than anything that had ever existed. Wold knew that size would create problems. When you own hundreds of billions of dollars in stocks, you can't just buy and sell whenever you want without moving markets. Your trading decisions become market-moving events. Your investment philosophy becomes everyone else's investment philosophy. You become too big to ignore and too influential to remain neutral. This led to what Wold called the Great Responsibility Principle. Norway's fund wouldn't just be an investor, it would be a steward of global capitalism. Every investment decision would need to consider not just financial returns, but social and environmental impact. They would use their ownership stakes to influence corporate behavior toward more sustainable and ethical practices. In 1990, this was a radical concept. Most investors in 1990 focused purely on financial returns. Environmental, social, and governance (ESG) investing was barely a footnote in finance textbooks. The idea that a massive investment fund would voluntarily sacrifice some returns to promote ethical behavior seemed naive at best, financially irresponsible at worst. But Wold had studied the history of large investment institutions, and he had noticed a pattern. The most successful long-term investors weren't those who chased maximum short-term returns. They were those who built sustainable, diversified portfolios and held them for decades. Warren Buffett's Berkshire Hathaway worked this way. University endowments like Harvard and Yale worked this way. Generational wealth was built through patient, ethical investing, not aggressive speculation. Norway's fund would take this philosophy to its logical extreme. They would buy and hold stocks for decades. They would never engage in speculative trading or market timing. They would focus on owning pieces of the best companies in the world and letting compound growth work its magic over multiple decades. The strategy was elegant, but implementing it required solving problems that no investor had ever faced before. First, they needed to hire investment managers capable of responsibly deploying hundreds of billions of dollars. This wasn't just about finding smart people. They needed people who understood that Norway's fund represented the savings of an entire nation and couldn't afford to take excessive risks. Second, they needed to build investment infrastructure that could operate across multiple continents in dozens of currencies, while maintaining the transparency standards that Norwegian democracy demanded. Every investment decision would eventually be disclosed to the Norwegian Parliament and the Norwegian people. Third, they needed to establish ethical guidelines that could scale. It was one thing to avoid investing in tobacco companies when you had $25 billion. It would be much more complicated when you had $500 billion and owned significant stakes in thousands of companies, many of which had complex ethical profiles. The breakthrough came when Vold recruited Klaas Knot, a Dutch central banker who had helped manage the Netherlands' smaller oil fund. Knot brought something crucial: experience with the practical challenges of large-scale sovereign investing. Knot's first insight was counterintuitive. Instead of trying to actively beat market returns through clever stock picking, Norway's fund should try to own the entire global stock market in proportion to each company's size. This index investing approach would minimize trading costs, reduce the risk of major losses, and ensure that Norway participated proportionally in global economic growth. The beauty of index investing was that it required no market timing, no stock picking, and no complex strategies that could go wrong. Norway would simply buy a representative sample of every publicly traded company in the world and hold those investments forever. As the global economy grew, Norway's wealth would grow with it. But there was a problem with index investing. Most stock market indices included companies that many Norwegians found ethically objectionable: tobacco companies, weapons manufacturers, companies with poor environmental records, companies operating in countries with terrible human rights records. This led to Norway's most innovative contribution to global finance, the concept of ethical indexing. Norway would create their own global stock market index that excluded companies based on ethical criteria, then invest according to that modified index. The ethical screening process was extraordinarily rigorous. Norway hired teams of researchers to investigate the business practices of thousands of companies worldwide. They established criteria for excluding companies involved in weapons production, tobacco, coal mining, and other industries deemed inconsistent with Norwegian values. But the screening went deeper than just industry exclusions. Norway would also exclude companies with poor labor practices, environmental violations, corruption scandals, or operations in countries with severe human rights abuses. They developed what became known as the Norwegian Standard, a set of ethical criteria that were more demanding than any other major investor had ever implemented. Critics argued that ethical investing was a luxury that Norway couldn't afford. By excluding potentially profitable companies and industries, Norway was voluntarily reducing their investment returns. Over decades, this could cost Norwegian taxpayers hundreds of billions in lost wealth. Wold's response was characteristically thoughtful. "We are not just building wealth for Norwegians, we are building wealth Norwegian style. If we compromise our values to maximize returns, we will have succeeded financially, but failed as a society." By 1996, the transformation was complete. Norway had created what was officially called the Government Pension Fund Global, though everyone would come to know it simply as the Oil Fund. The fund had grown to $60 billion and was invested in over 3,000 companies across 50 countries. But the really impressive growth was still ahead. Oil prices were about to enter a period of sustained increase that would last for over a decade. New oil discoveries in the North Sea were proving larger than initial estimates, and most importantly, global stock markets were entering one of the greatest bull markets in history. Norway's little experiment in ethical capitalism was about to become the largest investment fund in human history. And as it grew, it would begin to reshape how capitalism itself worked. The question was whether the rest of the world was ready for a new kind of economic superpower, one that prioritized long-term sustainability over short-term profits, one that used transparency instead of secrecy, and one that measured success not just in financial returns, but in social and environmental impact. What Norway had built was more than just an investment fund. It was a demonstration that there was a different way to manage wealth, a different way to think about capitalism, and a different way for nations to interact with the global economy. The demonstration was about to go global. Chapter 3: Silent Giant. While the rest of the world watched their savings evaporate in the global financial crisis, something extraordinary was happening in Oslo. Norway's oil fund was buying, massively. As stock markets crashed and panicked investors sold everything, Norway's fund managers were calmly executing the largest opportunistic investment strategy in modern history. They purchased $60 billion worth of stocks during the crisis at fire sale prices. Bank of America shares for $3 each, Apple stock for $12 per share, European blue chips at 50% discounts to their previous highs. This wasn't luck. This was the strategy working exactly as designed. While other investors were forced to sell to meet redemptions or margin calls, Norway's fund had no outside investors to satisfy, no quarterly earnings pressure, and no short-term obligations. They could afford to buy when everyone else was selling. They could afford to think in decades while everyone else was panicking about the next quarter. The architect of this crisis strategy was Ingvar Slingstad, who had recently become the fund's chief investment officer. Slingstad was a former McKinsey consultant with a PhD in finance from the Wharton School. More importantly, he was a true believer in the Norwegian model of patient, long-term investing. When Lehman Brothers collapsed in September 2008, Slingstad gathered his team for an emergency meeting. The question wasn't whether to buy more stocks. It was how fast they could deploy their cash reserves to take advantage of the panic selling. "This is exactly what we prepared for," Slingstad told his investment committee. "When everyone else is forced to sell, we have the luxury of buying. This crisis will pass. These companies will recover, and Norway will own larger stakes in the best companies in the world at prices we may never see again." The scale of Norway's crisis buying was unprecedented. In the fourth quarter of 2008 alone, they purchased more stocks than most major pension funds buy in an entire year. They were adding $200 million worth of new positions every single trading day. But here's what made Norway's strategy truly remarkable. They weren't just buying randomly. They were using the crisis to systematically increase their ownership stakes in companies they believed represented the future of the global economy. Technology companies like Google, Apple, and Microsoft, healthcare innovators like Johnson & Johnson and Roche, renewable energy pioneers like Vestas and First Solar, consumer brands like Nike, Coca-Cola, and ASML, financial services companies that survived the crisis like JP Morgan Chase and Goldman Sachs. By the end of 2009, Norway owned meaningful stakes in virtually every major publicly traded company in the developed world. They had become the largest foreign investor in European markets, the second largest foreign investor in American markets, and a major presence in Asian markets. The results were staggering. The stocks Norway bought during the 2008 crisis would generate over $300 billion in profits over the next decade. Apple alone, which Norway bought heavily at $12 per share, would eventually trade above $180 per share. Their crisis investments generated returns that exceeded 1,000% in some cases. But the financial gains were only part of the story. Norway's crisis buying had given them something even more valuable: influence. When you own 1% or more of a major company, you get a seat at the table. You get invited to private meetings with management. You get advance warning of major strategic decisions. You get the opportunity to influence corporate behavior in ways that align with your values. By 2010, Norway was the largest shareholder in over 1,000 publicly traded companies worldwide. They owned more than 1% of Apple, Microsoft, Google, Amazon, and virtually every other technology giant. They owned significant stakes in major banks, oil companies, pharmaceutical companies, and consumer brands. This level of ownership concentration had never existed before in the history of capitalism. No single investor had ever controlled such a large and diverse portfolio of global corporate assets. And Norway was using this influence in ways that were reshaping how multinational corporations operated. The transformation started with something called active ownership. Instead of being passive investors who simply bought stocks and hoped for the best, Norway began using their shareholder rights to influence corporate behavior. They voted against executive compensation packages they deemed excessive. They pushed for more women on corporate boards. They demanded stronger environmental policies and better labor standards. Most importantly, they began divesting from companies that didn't meet their ethical standards and publicly explaining why. In 2010, Norway sold all their holdings in Walmart, citing the company's labor practices and environmental record. The divestment was worth over $400 million and sent shockwaves through the retail industry. When the Norwegian oil fund sells your stock and publicly explains that it's because of ethical concerns, other institutional investors pay attention. The Walmart divestment was followed by similar actions against tobacco companies, weapons manufacturers, coal mining companies, and firms operating in countries with poor human rights records. Each divestment was accompanied by detailed public reports explaining Norway's reasoning. What made these divestments particularly powerful was Norway's credibility. This wasn't a small activist fund trying to generate publicity. This was the largest sovereign wealth fund in the world, making investment decisions based on rigorous analysis and transparent criteria. When Norway divested from an industry or company, it often triggered similar actions by other major institutional investors. The influence extended beyond individual companies to entire industries. When Norway announced in 2012 that they would systematically divest from coal mining companies due to climate change concerns, it accelerated a global movement away from coal investments. Major pension funds, university endowments, and insurance companies began implementing similar policies. Norway had essentially created a new form of economic diplomacy. Instead of using military power or trade sanctions to influence global behavior, they were using their investment decisions to promote their values. Companies that wanted access to Norway's capital needed to meet Norway's standards. But the strategy wasn't without costs. Norway's ethical screening process excluded them from some of the most profitable investments of the 2010s. They couldn't invest in many Chinese companies due to human rights concerns. They missed out on some oil and gas companies that generated massive returns. They avoided defense contractors that benefited from increased military spending. Critics argued that Norway was imposing their values on the global economy and potentially reducing returns for Norwegian taxpayers. Some estimated that ethical screening was costing Norway's fund 0.1% to 0.3% in annual returns. Small percentages that could add up to tens of billions of dollars over time. Slingstad's response reflected the sophisticated thinking that had guided Norway's approach from the beginning. We are not trying to maximize returns over the next year or even the next decade. We are trying to maximize returns over the next century. Companies and industries that ignore environmental and social sustainability will not be profitable in the long term. Our ethical screening is not just morally correct, it's financially prudent. The data supported Slingstad's argument. Companies that scored highly on environmental, social, and governance metrics consistently outperformed companies with poor ESG scores over periods of 10 years or longer. Industries that ignored climate change faced increasing regulatory pressure and stranded assets. Companies with diverse leadership teams and strong labor practices showed better innovation and lower employee turnover. By 2015, Norway's ethical indexing approach was being copied by investors managing trillions of dollars worldwide. Major pension funds adopted similar screening criteria. University endowments began divesting from fossil fuels. Insurance companies started factoring climate change into their investment decisions. Norway had proven that ethical investing wasn't just morally superior, it was financially superior for long-term investors. They had demonstrated that a massive investment fund could use its influence to promote positive change while generating strong returns for its beneficiaries. The fund had grown to over $800 billion by 2015, making it larger than the GDP of most countries. Norway now owned an average of 1.3% of every publicly traded company in the world. They were the largest single shareholder in over 2,000 companies across 6 continents. But size was creating new challenges. When you own $800 billion worth of global stocks, your trading decisions move markets. When you announce an investment strategy change, other investors pay attention and often copy your approach. When you divest from an industry, that industry's stock prices declined significantly. Norway had become what economists call a systemically important investor. Their decisions didn't just affect their own returns, they affected global financial stability. This was unprecedented territory for any investment fund, and it raised complex questions about responsibility and influence. The little oil fund that had started with 25 billion in 1990 had become something much more significant, a global economic superpower that was reshaping capitalism through patient, ethical investing. And they were just getting started. Chapter 4: Global Reach. In a glass office tower overlooking London's financial district, Norway's fund was making a decision that would reshape global real estate markets forever. They were buying the most expensive single real estate portfolio in British history, $13 billion worth of prime London properties, including massive shopping centres on Oxford Street, office buildings in Canary Wharf, and luxury residential developments in Mayfair. But this wasn't just about London. Simultaneously, Norway was acquiring landmark properties in Manhattan, office towers in Tokyo, shopping malls in Paris, and residential developments in Sydney. They were becoming one of the largest real estate owners on Earth. The mastermind behind this global real estate expansion was Karsten Kalevig, Norway's new head of real estate investments. Kalevig had previously managed real estate portfolios for major European pension funds, but nothing had prepared him for the scale of what Norway was attempting. The fund's real estate strategy was breathtakingly ambitious. They would own trophy properties in every major global city, focusing on assets that could generate stable rental income for decades while appreciating in value over time. They weren't just buying buildings, they were buying pieces of the most valuable urban real estate on Earth. By 2018, Norway owned over $80 billion in real estate across 30 countries. They owned Times Square office buildings that housed major American corporations. They owned shopping centers in Frankfurt that attracted millions of visitors annually. They owned residential complexes in Singapore that housed tens of thousands of people. The scale was unprecedented. No single investor had ever assembled such a diverse and valuable real estate portfolio. Norway wasn't just participating in global real estate markets, they were reshaping them. The strategy revealed something profound about how Norway's fund thought about long-term wealth creation. While most investors focused on stocks and bonds, Norway understood that the truly wealthy own hard assets, real estate, infrastructure, natural resources, and businesses that generate income regardless of what happens in financial markets. Real estate was particularly attractive because it offered something that stocks couldn't: direct control. When Norway owned shares in Apple or Microsoft, they were minority investors with limited influence. When Norway owned a building in Manhattan or London, they controlled how that property was managed, developed, and maintained. This control allowed Norway to implement their sustainability standards in ways that were reshaping global real estate development. Every property Norway acquired was retrofitted with energy-efficient systems. Solar panels, advanced insulation, smart building technologies, and sustainable materials became standard features of Norway-owned properties. The influence extended beyond individual buildings to entire urban neighborhoods. In London, Norway's massive property acquisitions in King's Cross transformed what had been a declining industrial area into one of Europe's most sustainable mixed-use developments. In Manhattan, their real estate investments helped accelerate the development of energy-efficient office buildings that became models for sustainable urban architecture. But real estate was only one dimension of Norway's expanding global influence. By 2018, the fund had grown to over $1 trillion and was implementing what they called integrated ownership strategies across multiple asset classes. In infrastructure, Norway was investing in toll roads, airports, power grids, and telecommunications networks across 6 continents. They owned pieces of the electrical grid that powers much of Northern Europe. They owned stakes in airports that handle hundreds of millions of passengers annually. They owned fiber optic networks that carry significant portions of global internet traffic. In private equity, Norway was becoming a major investor in unlisted companies, particularly those focused on renewable energy, healthcare innovation, and educational technology. They were funding the development of offshore wind farms in the North Sea, medical device companies in Switzerland, and educational software companies in California. The integrated approach was generating extraordinary returns. Norway's real estate investments were producing annual returns of 7 to 9%. Their infrastructure investments were generating steady income streams that grew with inflation. Their private equity investments were giving them access to high-growth companies before they became publicly traded. More importantly, the diversified approach was making Norway's fund virtually recession-proof. When stock markets declined, their real estate values remained stable. When inflation increased, their infrastructure investments generated higher income. When certain geographic regions faced economic problems, their global diversification protected overall returns. By 2019, Norway's fund was generating over 150 billion annually in investment income, more than Norway's entire government budget. The fund was literally making more money than the Norwegian economy could generate through traditional economic activity. This created what economists called the Norway problem. What do you do when your investment fund becomes larger and more profitable than your actual economy? The answer revealed Norway's most sophisticated insight about long-term wealth management. Instead of spending the investment income immediately, they were reinvesting most of it back into the fund. Norway was using their current wealth to build even greater wealth for future generations. The strategy was working beyond anyone's most optimistic projections. The fund that was supposed to reach $500 billion by 2020 had already exceeded $1 trillion by 2018. Conservative projections suggested it could reach $2 trillion by 2030 and $5 trillion by 2050. At $5 trillion, Norway's fund would be larger than the entire American stock market was in 2000. It would be larger than the combined GDP of Germany and Japan. Every Norwegian citizen would theoretically own nearly $1 million of global assets. But size was creating unprecedented challenges. Norway now owned meaningful stakes in so many companies that their investment decisions affected global economic stability. When they changed their asset allocation strategies, trillions of dollars moved across global markets. When they announced new ethical screening criteria, entire industries faced pressure to change their business practices. The influence was particularly visible in corporate governance. Norway's fund was now the largest or second largest shareholder in thousands of companies worldwide. They were voting on tens of thousands of corporate resolutions annually. Their positions on executive compensation, board diversity, environmental policies, and business ethics were becoming global standards. In 2019, Norway announced that they would begin requiring all companies in their portfolio to achieve net zero carbon emissions by 2050. Given that Norway owned stakes in virtually every major publicly traded company on Earth, this requirement effectively meant that global corporate climate policy would be shaped by Norwegian standards. The announcement triggered the largest wave of corporate climate commitments in history. Companies that wanted continued access to Norway's capital began announcing aggressive carbon reduction targets. Industries that had previously ignored climate change suddenly found themselves under pressure to develop sustainable business models. Norway had achieved something unprecedented in the history of capitalism. They had created a source of investment capital so large and influential that it could reshape global corporate behavior simply through its investment criteria. But this influence came with enormous responsibility. Norway's fund managers weren't just making investment decisions for Norwegian taxpayers. They were making decisions that affected global economic stability, corporate behavior, and environmental policy. The question was whether any single country should have such disproportionate influence over global capitalism, and whether Norway was prepared for the backlash that was beginning to emerge from countries and industries that didn't appreciate being subject to Norwegian ethical standards. The little oil fund from a small Nordic country had become something unprecedented, a global economic superpower that operated according to principles of transparency, sustainability, and long-term thinking that challenged the fundamental assumptions of how capitalism was supposed to work. And the world was starting to push back. Chapter 5: Ethical Dilemma. In the depths of the COVID pandemic, As governments worldwide struggled to fund emergency response measures, Norway faced a moral crisis that would test everything they had built over 5 decades. The fund was approaching $1.2 trillion in value, but Norway's economy was in recession. Oil prices had collapsed, unemployment was rising. The government needed massive spending to support businesses and workers through the crisis. For the first time in the fund's history, Norway was being forced to withdraw money to cover government spending shortfalls. They would need to sell over $20 billion in assets to fund pandemic response measures. The withdrawal sparked a fierce national debate that revealed deep contradictions in Norway's approach to wealth management. If the fund was supposed to benefit future generations, was it ethical to spend it on current emergencies? If the fund was built on oil wealth, was it moral to use it while simultaneously fighting climate change? The ethical tensions that had been simmering beneath the surface of Norway as success were finally erupting into public view. The most vocal critic was Dr. Fredrik Hauge, founder of the Norwegian environmental organization Bellona. Hauge had spent decades arguing that Norway's entire approach was fundamentally hypocritical. How could a country claim to be a global leader on climate change while building its wealth from fossil fuel extraction? Norway has become rich by selling the rope that the world is using to hang itself, Hauge argued in a widely circulated essay. We cannot claim moral authority while our prosperity depends on destroying the planet's climate. Hauge's criticism wasn't just philosophical, it was backed by hard data. Norway's oil and gas exports were responsible for roughly 2% of global carbon emissions. The fund that was supposedly promoting sustainable investing was built entirely on unsustainable fossil fuel extraction. The contradiction became more acute as the fund grew larger and more influential. Norway was using oil money to pressure other companies to reduce their carbon emissions while simultaneously producing more oil to generate more money to invest in fighting climate change. This led to what economists called the Norwegian paradox. The more successful Norway became at ethical investing, the more unethical their core business model appeared. The debate intensified when Norway's Ethics Council, which advises the fund on investment decisions, published a comprehensive analysis of the fund's climate impact. The report concluded that Norway's fund was simultaneously one of the most progressive forces for corporate climate action and one of the largest contributors to climate change through its underlying oil wealth. The analysis revealed the scope of Norway's influence on global climate policy. Companies in Norway's portfolio, representing over $1 trillion in market value, were implementing carbon reduction strategies directly influenced by Norwegian pressure. These companies were collectively reducing their emissions by hundreds of millions of tons annually, but Norway's oil and gas production was adding roughly 500 million tons of carbon emissions annually to the atmosphere. From a pure climate accounting perspective, Norway was contributing more to climate change than they were preventing through their ethical investing. The mathematical reality was uncomfortable. Norway would need to prevent roughly twice as many emissions through their investment influence as they caused through oil production to achieve climate neutrality. Given that they owned only 1.5% of global stocks, this was mathematically impossible. The realization led to the most serious political crisis in the fund's history. Environmental groups demanded that Norway immediately cease oil production and transition to a post-oil economy. Labor unions argued that ending oil production would destroy hundreds of thousands of jobs and tank the Norwegian economy. Conservative politicians warned that divesting from oil would eliminate the source of wealth that made the fund possible. The debate reached a climax during the 2021 national elections, when the future of oil production became the central campaign issue. For the first time, a significant portion of Norwegian voters supported immediately ending oil extraction, even if it meant slower growth for the investment fund. The election results were inconclusive. Norwegians were essentially split between those who wanted to maintain oil production to maximize the fund's growth, and those who wanted to end oil production to maximize Norway's climate credibility. The new government, led by Prime Minister Jonas Gahr Støre, attempted a compromise that satisfied no one while highlighting the fundamental contradictions in Norway's position. They would continue oil production, but accelerate the timeline for transitioning to renewable energy. They would use oil revenues to fund the most aggressive climate transition in global history. The compromise led to what became known as the green transition strategy. Norway would use their oil wealth to become the world's first major oil producer to completely eliminate domestic carbon emissions. They would electrify everything: transportation, heating, industrial processes, and even oil extraction itself. More controversially, they would use the investment fund to accelerate global renewable energy development by systematically divesting from fossil fuel companies and redirecting that capital toward clean energy investments. The divestment strategy was unprecedented in scale. Norway announced that they would sell over $40 billion worth of oil and gas company stocks over 5 years. The money would be reinvested in renewable energy companies, battery manufacturers, electric vehicle producers, and clean technology innovators. The announcement sent shockwaves through global energy markets. Norway wasn't just divesting from fossil fuels, they were doing it at a scale that would significantly impact the stock prices of major oil companies. ExxonMobil, Shell, Chevron, and BP all saw their stock prices decline as investors anticipated reduced demand from institutional investors following Norway's lead. But the strategy faced practical challenges that revealed how difficult it would be for Norway to fully escape their dependence on oil wealth. Renewable energy investments generated lower returns than oil investments, at least in the short term. Clean technology companies were often unproven and risky. Electric vehicle manufacturers were valued at unsustainable multiples. More fundamentally, Norway's oil production was so profitable that it generated more wealth in a single year than they could realistically invest in clean energy alternatives. The fund was growing faster from oil revenues than they could redirect towards sustainable investments. This led to what critics called the sustainability trap. Norway's commitment to maximizing returns for future generations conflicted with their commitment to environmental sustainability. The most profitable path forward involved continued oil extraction, but the most sustainable path forward required abandoning their most profitable industry. The dilemma became personal for Nicolai Tangen, who had become the fund's new chief executive officer in 2020. Tangen was a former hedge fund manager who had built his career on generating maximum returns for investors. But he was also a Norwegian citizen who believed deeply in environmental responsibility. Tangen's solution was characteristically Norwegian: extreme transparency and democratic decision-making. Instead of resolving the ethical dilemmas internally, Norway would make them public and let Norwegian citizens decide how to balance wealth creation against environmental responsibility. Starting in 2021, Norway began publishing annual ethical impact reports that detailed exactly how much wealth the fund generated from oil-related investments versus sustainable investments. They calculated the carbon footprint of every investment. They estimated the environmental impact of their corporate influence activities. Most importantly, they began asking Norwegian citizens directly, how much financial return are you willing to sacrifice to accelerate climate action? The answer would determine not just the future of Norway's fund, but the future of sustainable capitalism globally. If the world's most successful sovereign wealth fund couldn't solve the tension between maximizing returns and maximizing sustainability, it raised profound questions about whether ethical capitalism was possible at the scale needed to address global challenges. The Norwegian experiment was entering its most critical phase. Chapter 6, Market Mover, March 2022. As Russian tanks rolled into Ukraine, financial markets around the world began experiencing something unprecedented: an entire country's worth of investments disappearing overnight. Norway's fund held $2.8 billion in Russian assets when the invasion began. Within 72 hours, those investments had become essentially worthless as international sanctions made it impossible to trade Russian securities. But what happened next revealed the true scale of Norway's influence on global markets. The fund didn't just write off their Russian losses and move on. They used the crisis to demonstrate something that had never been attempted before: the complete financial isolation of a major economy through coordinated divestment. Nicolai Tangen gathered his team for an emergency strategy session on February 26th, 2 days after the invasion began. The question wasn't whether to divest from Russian assets. That decision had been made immediately. The question was how to use Norway's divestment to maximum effect in supporting Ukraine and isolating Russia. We have an opportunity to show that financial markets can be a force for international justice, Tangen told his investment committee. Russia depends on international capital to fund their economy. If we can trigger a broader exodus of international investment, we can impose costs that go beyond government sanctions. The strategy they developed was unprecedented in the history of sovereign wealth funds. Norway would not only divest from Russian assets, but they would publicly detail their reasoning and encourage other institutional investors to follow their lead. Within a week, Norway had published a comprehensive report explaining why Russian investments were incompatible with the fund's ethical guidelines and long-term investment strategy. The report wasn't just about the Ukraine invasion. It was a detailed analysis of how authoritarian governments create unsustainable investment environments. The report's impact was immediate and massive. Within 2 weeks of Norway's announcement, institutional investors managing over $200 billion had announced similar divestments from Russian assets. University endowments, pension funds, and sovereign wealth funds around the world followed Norway's lead. The coordinated divestment created a cascade effect that accelerated Russia's financial isolation far beyond what government sanctions alone could have achieved. Russian companies found themselves unable to access international capital markets. The ruble collapsed. Russian oligarchs saw their international investment portfolios become illiquid. Norway had demonstrated something extraordinary. A large institutional investor could use their influence to support international law and human rights in ways that complemented traditional diplomacy. But the Russian divestment was just one example of how Norway's fund had become a market mover, whose investment decisions shaped global economic conditions. The scale of their influence was most visible in their quarterly rebalancing activities. 4 times per year, Norway adjusts their global portfolio to maintain their target allocations across different asset classes and geographic regions. These rebalancing trades involve buying and selling roughly 50–100 billion worth of assets in a single quarter. When Norway rebalances, global markets notice. Their trading activity is large enough to move stock prices, bond yields, and currency exchange rates. Other institutional investors monitor Norway's trades and often copy their strategies, amplifying the market impact. The phenomenon became known as the Norway effect. When Norway's fund increased their allocation to a particular country or sector, other investors often followed, driving up asset prices in those markets. When Norway reduced their exposure to certain investments, those assets often declined in value. The Norway effect was particularly powerful in smaller markets. When Norway decided to increase their allocation to South Korean stocks in 2021, the Seoul stock market experienced its best quarter in over a decade. When they reduced their exposure to Turkish bonds due to concerns about political stability, Turkish borrowing costs increased significantly. Norway's influence extended beyond just asset prices to corporate behavior. Companies that wanted to maintain access to Norway's capital began proactively adopting policies they knew would align with Norwegian preferences. The most dramatic example was the global acceleration of corporate climate commitments following Norway's announcement that they would systematically favor companies with aggressive carbon reduction targets. Within 6 months, over 300 major corporations had announced new net zero emission goals that directly referenced Norway's investment criteria. Samsung, Apple, Microsoft, and hundreds of other companies began restructuring their supply chains, investing in renewable energy, and changing their business models to meet standards they knew would influence Norway's investment decisions. This gave Norway something unprecedented in the history of capitalism: the ability to reshape global corporate behavior without government regulation or consumer pressure. Companies were voluntarily changing their practices to attract and retain Norwegian investment. The influence was perhaps most visible in executive compensation practices. Norway had long used their shareholder voting rights to oppose what they considered excessive CEO pay packages. By 2022, their opposition to high executive compensation had become so influential that major corporations began proactively restructuring their compensation systems to avoid Norwegian opposition. The consulting firm McKinsey estimated that Norway's activism on executive compensation had reduced average CEO pay at S&P 500 companies by roughly 15% compared to what it would have been without Norwegian pressure. But market influence came with significant responsibility and occasional unintended consequences. In 2021, Norway's decision to increase their allocation to technology stocks contributed to a massive rally in tech valuations that many economists later argued created an unsustainable bubble. When Norway subsequently reduced their tech exposure in early 2022, it contributed to the sharp decline in technology stock prices that erased trillions of dollars in market value. The scale of Norway's influence raised serious questions about market concentration and systemic risk. When a single investor controls over $1.3 trillion in global assets, their investment decisions affect not just their own returns, but global financial stability. This concern led to the creation of the Systemic Investment Risk Committee within Norway's central bank. The committee's job was to monitor how Norway's investment decisions affected global market stability and to modify their strategies when necessary to prevent unintended negative consequences. The committee's first major intervention came during the COVID-19 pandemic, when Norway deliberately slowed their crisis buying to avoid exacerbating market volatility. Even though buying aggressively during the pandemic would have been profitable for Norway, they recognized that their trading activity was large enough to destabilize already fragile markets. This restraint illustrated something remarkable about Norway's approach to wealth management. They were voluntarily limiting their profit maximization when it conflicted with broader social responsibilities. By 2023, Norway's fund had grown to over $1.4 trillion and showed no signs of slowing down. They were generating over $200 billion annually in investment income, more than the entire GDP of most countries. The fund now employed over 600 investment professionals, working across offices in London, New York, Shanghai, and Singapore. They were managing more money than all but the largest national economies generated in economic output. But perhaps most remarkably, they were doing it with a level of transparency that remained unmatched by any other major investment institution. Every investment decision, every vote cast, every divestment action was publicly documented and explained. Norway had proven that it was possible to manage unprecedented wealth while maintaining democratic accountability and ethical standards. They had shown that financial power could be used to promote positive social change rather than just maximize returns. The question now was whether Norway's model could be replicated by other countries, or whether it was a unique product of Norwegian culture, Norwegian oil wealth, and Norwegian political stability. As other nations watched Norway's success, many were beginning to wonder if they should build their own versions of the Norwegian model. China was developing plans for a massive sovereign wealth fund. Several European countries were considering pooling their resources to create a European equivalent to Norway's fund. The Norwegian experiment was no longer just about Norway. It was becoming a template for how nations could build and manage wealth in the 21st century. Chapter 7. Crisis Test. For the first time in the fund's history, Norway was facing a crisis that money couldn't solve. Global inflation had reached levels not seen since the 1970s. Interest rates were rising rapidly. Stock markets around the world were experiencing their worst performance since 2008. And Norway's fund was losing money faster than any investment institution in human history. The first quarter of 2023 alone, the fund lost over $164 billion, more than most countries' entire annual economic output. By mid-year, the losses had exceeded $300 billion, wiping out nearly 3 years of gains in just 6 months. The scale of the losses was staggering, but what made them particularly challenging was their timing. Norway's population was aging rapidly, and the government was facing mounting pressure to increase spending on healthcare, pensions, and infrastructure. For the first time since the fund's creation, there was serious political discussion about whether Norway needed to withdraw more money to meet current obligations. The crisis that hit global markets in 2023 was unlike anything investors had experienced in the modern era. It wasn't just a stock market decline or a bond market correction. It was a simultaneous collapse across virtually every asset class that had performed well during the previous decade. The trigger was a series of bank failures in the United States that reminded investors of the 2008 financial crisis. But unlike 2008, when central banks could respond by cutting interest rates and printing money, this crisis occurred while inflation was already dangerously high and interest rates were rising rapidly. Central banks faced an impossible choice: raise rates to fight inflation and risk a deeper recession, or cut rates to support markets and risk runaway inflation. Either choice would devastate different parts of the global economy. For Norway's fund, the crisis was particularly brutal because they had positioned their portfolio for a very different economic environment. Their massive holdings in technology stocks, which had generated extraordinary returns during the 2010s and early 2020s, were among the worst performers as investors fled risky assets. Their real estate investments, which had provided steady income during previous market downturns, were suffering as rising interest rates made property financing more expensive and reduced demand for commercial space. Even their bond holdings, traditionally a safe haven during stock market declines, were losing value as interest rates rose and investors worried about government debt sustainability. Nicolai Tangen faced the greatest test of his leadership. The man who had been hired to grow Norway's wealth was now presiding over the largest losses in the fund's history. Norwegian media was filled with criticism, questioning whether the fund's strategy needed fundamental changes. The pressure was intensified by the political context. Norway's governing coalition was facing declining poll numbers, partly due to economic challenges that the fund's losses seemed to symbolize. Opposition politicians were calling for investigations into the fund's management and questioning whether Tangen was the right person to lead Norway's most important institution. The 2023 losses weren't just a financial challenge. They represented an intellectual crisis that forced Norway to question fundamental assumptions about modern portfolio theory and long-term investing. For decades, investment theory had been built on the assumption that diversification across asset classes would reduce risk. Stocks and bonds were supposed to move in opposite directions. Real estate was supposed to provide stability during market volatility. International diversification was supposed to protect against regional economic problems. But in 2023, virtually everything declined simultaneously. The correlations between different asset classes approached 1.0, meaning they were moving in perfect synchronization. Diversification, the foundation of modern portfolio management, had failed when it was needed most. The failure was particularly challenging for Norway because their entire investment philosophy was built on diversification. They owned stocks, bonds, real estate, and infrastructure across dozens of countries and currencies. Their strategy was designed to perform well in virtually any economic environment except the one they were actually experiencing. Dr. Knut Anton Mork, the Norwegian economist who had previously warned about the fund's scale problems, published a devastating analysis arguing that modern portfolio theory was fundamentally flawed in an era of global financial integration. When central banks coordinate policy globally, when supply chains span continents, and when information flows instantly across markets, there is no such thing as true diversification, Mork argued. All assets are exposed to the same underlying risks: currency debasement, political instability, and technological disruption. The analysis suggested that Norway's losses weren't just bad luck. They were the inevitable result of trying to apply 20th century investment theory to 21st century financial markets. But the intellectual crisis went deeper than just portfolio theory. The losses forced Norway to confront uncomfortable questions about the relationship between financial markets and real economic value. The fund's losses were particularly painful because they occurred while Norway's actual economy was performing relatively well. Oil and gas revenues were strong due to the energy crisis triggered by the Ukraine war. Norwegian companies were profitable. Unemployment was low. The country's fiscal position was sound. Yet Norway was becoming poorer on paper because global financial markets were declining. The disconnect between financial markets and economic reality forced uncomfortable questions about whether the fund's paper wealth had ever been real in the first place. The questioning was led by Professor Steinar Holden from the University of Oslo, who had long been skeptical of Norway's focus on financial asset accumulation. "We have spent 30 years converting oil into stock certificates," Holden argued in a widely discussed academic paper. "But stock certificates are only valuable if someone else is willing to buy them. When everyone wants to sell simultaneously, we discover that much of our supposed wealth was illusory." Holden's analysis was particularly troubling because it suggested that Norway's losses might be permanent rather than temporary. If global demographics, debt levels, and political instability had fundamentally changed the risk-return characteristics of financial markets, then waiting for a recovery might be futile. The argument gained credibility when several prominent international investors began arguing that the era of strong stock market returns was over. Warren Buffett, in his annual letter to Berkshire Hathaway shareholders, warned that investors should expect much lower returns in the coming decades due to high valuations, demographic changes, and geopolitical instability. If Buffett was correct, then Norway's strategy of accumulating financial assets for future generations might leave those generations with assets that generated inadequate returns to justify the environmental and social costs of oil extraction. The fund's losses created the most serious political crisis in its history. For the first time, a significant portion of Norwegian voters began questioning whether the fund's strategy needed fundamental changes. The criticism came from multiple directions. Environmental groups argued that the losses proved that financial markets were too unstable to justify continued oil production. If Norway was going to damage the environment to build wealth for future generations, that wealth needed to be more secure than volatile financial assets. Labor unions argued that the losses demonstrated the need to spend more oil money domestically rather than investing it abroad. Norway could use oil revenues to build infrastructure, fund research, and develop new industries that would provide jobs and economic security regardless of what happened. In global financial markets, conservative politicians argued that the losses resulted from the fund's focus on ethical investing rather than pure profit maximization. They claimed that Norway's environmental and social screening criteria had prevented the fund from investing in the most profitable sectors, leading to underperformance. During the crisis, the political pressure intensified when several prominent Norwegian economists published a controversial analysis arguing that the fund had become too big to succeed. Their argument was counterintuitive, but mathematically compelling. The fund now owned such large stakes in global markets that its own trading activity was negatively affecting its returns. When the fund tried to buy more stocks, their purchasing drove up prices, making their investments more expensive. When they tried to sell assets, their selling drove down prices, reducing their returns. The fund had become so large that it was competing with itself in global markets. The economists proposed a radical solution. Norway should consider distributing portions of the fund directly to Norwegian citizens rather than trying to manage increasingly unwieldy amounts of global investment capital. The proposal sparked fierce debate about the fundamental purpose of the fund. Was it supposed to maximize returns for future generations, or was it supposed to benefit current Norwegians who had created the wealth through their oil resources? Nicolai Tangen's response to the crisis revealed the sophisticated thinking that had guided Norway's approach for over 30 years. Instead of panicking about short-term losses or fundamentally changing strategy, he used the crisis to reinforce Norway's commitment to long-term thinking. "This is exactly why we built a fund instead of spending oil money immediately," Tangen explained to Parliament in a remarkably calm presentation during the height of the crisis. Markets fluctuate, economies go through cycles, but patient capital, invested across decades, generates wealth that no single economic cycle can destroy. To prove his point, Tangen published the most comprehensive analysis of the fund's performance that had ever been released. The data told a remarkable story of long-term success despite short-term volatility. Since 1998, when the fund began serious, global investing, it had generated average annual returns of 9% after inflation. The $300 billion in losses in 2023 represented just 2.3% of the fund's total value. Even after the losses, the fund was worth more than 3 times what it had been worth in 2015. More importantly, the fund's diversification strategy was working exactly as designed, just not in the way that most people understood diversification. The key insight was that Norway wasn't just diversified across asset classes, they were diversified across time. The fund was designed to perform well over decades, not quarters or years. Short-term volatility was the price they paid for long-term, returns that exceeded what any single generation could achieve through traditional economic activity. Tangen's analysis revealed that the fund's losses were actually less severe than those experienced by most other major investors during the crisis. University endowments, pension funds, and sovereign wealth funds around the world had lost similar percentages of their value, but they lacked Norway's financial resources to wait for recovery. But Tangen went further than just defending the fund's performance. He used the crisis to demonstrate Norway's most innovative contribution to institutional investing: counter-cyclical strategy implementation. Instead of reducing risk during the market decline, Norway was systematically increasing their stock holdings while prices were depressed. They were using the same crisis buying strategy that had generated massive returns during the 2008 financial crisis and the 2020 pandemic. The strategy required extraordinary intellectual courage. While every financial media outlet was predicting further declines, while other institutional investors were reducing their equity exposure, and while Norwegian politicians were questioning the fund's basic approach, Tangen was doubling down on the strategy that was generating the largest losses. Throughout 2023, as other investors pulled money out of stock markets, Norway was buying roughly $15 billion worth of additional stocks each quarter. They were increasing their ownership stakes in companies like Apple, Microsoft, and Google, while their stock prices were 30–40% below previous highs. The purchases were enormous in scale. In some quarters, Norway was responsible for over 10% of all institutional buying in global stock markets. Their trading activity was large enough to provide meaningful support to declining prices, effectively making them a buyer of last resort during the panic. But the strategy wasn't just about buying stocks indiscriminately. Norway was using the crisis to systematically increase their ownership in companies they believed represented the future of the global economy. They were buying technology companies that were developing artificial intelligence, renewable energy companies that were scaling clean energy production, healthcare companies that were advancing longevity research, and infrastructure companies that were building the physical systems needed for economic growth in developing countries. The targeted buying reflected Tangen's belief that the 2023 crisis was creating once-in-a-generation opportunities to acquire stakes in transformational companies at discounted prices. The crisis also provided an opportunity to test some of the mathematical models that had guided Norway's investment strategy for decades. Dr. Yves Chouet-Fati, a French mathematician who had consulted with Norway on portfolio optimization, published a real-time analysis of how Norway's crisis buying was affecting global market dynamics. Chouet-Fati's analysis revealed something remarkable. Norway's purchasing activity was actually reducing the volatility of global stock markets. Their systematic buying during declines was providing price support that prevented markets from falling as far as they would have without Norwegian intervention. The stabilization effect was mathematically measurable. Chouet-Fati estimated that Norway's crisis buying prevented global stock markets from declining by an additional 10 to 15%. The fund that had been built to benefit from market volatility was now large enough to reduce market volatility through its own trading activity. This created a fascinating paradox. Norway's contrarian investing strategy was becoming less profitable precisely because it was becoming more successful. As their crisis buying provided market support, the opportunities for buying at deeply discounted prices became less available. The realization led Norway's investment team to develop what they called graduated contrarian strategies. Instead of buying aggressively during every market decline, They would scale their crisis buying based on the severity of the decline and their assessment of underlying market conditions. The approach required even more sophisticated analysis and longer-term thinking than their previous strategies. Norway was essentially trying to optimize their contrarian investing to account for their own market impact. The mathematical complexity was unprecedented in the history of institutional investing. Norway was managing portfolios so large that they needed to account for how their own trading decisions affected the prices of the assets they were buying and selling. By the fourth quarter of 2023, Tangen's strategy was beginning to pay off spectacularly. Global stock markets stabilized and began recovering, driven partly by central bank policy changes and partly by investor recognition that many high-quality companies were trading at unsustainably low prices. Norway's crisis purchases started generating positive returns almost immediately. The Apple stock they had bought at $140 per share in March was trading above $180 by December. The Microsoft shares they had purchased at $250 were approaching $350. The European stocks they had bought during the banking crisis had rebounded by 40–50%. More importantly, Norway's crisis buying had once again increased their ownership stakes in many of the world's best companies at discounted prices. They now owned larger portions of the global economy than ever before, positioning them to benefit disproportionately from the eventual recovery. The fund's losses began shrinking rapidly. By December 2023, they had recovered over $200 billion of their peak losses. By March 2024, the fund had reached new record highs, exceeding its pre-crisis value by over $100 billion. The recovery vindicated every aspect of Norway's long-term investment philosophy. Their diversification strategy had limited losses compared to more concentrated portfolios. Their patient approach had allowed them to avoid panic selling at the bottom. Their contrarian buying had generated extraordinary returns as markets recovered. Most importantly, the crisis had demonstrated that Norway's fund was now large enough to influence global financial stability through their own trading decisions. They weren't just benefiting from market cycles, they were helping to moderate those cycles through their systematic approach to buying, during declines and maintaining discipline during euphoria. The 2023 crisis marked a turning point in how other institutional investors viewed Norway's approach to wealth management. For decades, Norway had been seen as an interesting experiment in ethical investing that might sacrifice returns for social goals. The crisis revealed that Norway's approach wasn't just ethically superior, it was financially superior for long-term investors. Their commitment to patient capital, diversification, and contrarian strategies had generated better risk-adjusted returns than virtually any other major investment institution. Universities, pension funds, sovereign wealth funds, and family offices around the world began studying Norway's crisis response and implementing similar strategies. The 2023 crisis accelerated the global adoption of Norwegian-style investing principles. But perhaps most importantly, the crisis had validated the fundamental assumptions underlying Norway's approach to converting natural resource wealth into financial wealth. Oil and gas were finite resources that would eventually be depleted. But properly invested financial capital could generate returns indefinitely. The volatility that made financial markets scary in the short term was exactly what created opportunities for patient investors to build wealth that would last for generations. Norway had proven that a small country with smart institutions could build wealth that exceeded what much larger countries achieved through traditional economic development. They had demonstrated that long-term thinking, when supported by adequate capital and appropriate institutions, could overcome short-term market panics and generate prosperity that benefited entire societies. The fund's success during the 2023 crisis solidified Norway's reputation as the world's most sophisticated institutional investor and provided a template for how other countries might build and manage wealth in an increasingly complex global economy. The crisis that was supposed to test Norway's model had instead proven its superiority. Chapter 8. Future Power in a Secure Conference Room in Oslo. Norway's government was debating a question that would determine the future of global capitalism. What do you do when your investment fund becomes larger than most national economies? The fund had reached 1.5 trillion, making it larger than the GDP of Canada, Russia, or South Korea. Every Norwegian citizen now theoretically owned $280,000 worth of global assets. The fund was generating over $250 billion annually in investment income, enough to fund Norway's entire government budget twice over. But the scale was creating problems that no investor had ever faced before. Norway now owned meaningful stakes in virtually every major company on Earth. They were the largest or second largest shareholder in thousands of corporations across 6 continents. Their investment decisions affected global market stability, corporate behavior, and economic policy in dozens of countries. The influence was becoming so pervasive that some economists were arguing Norway had achieved what amounted to economic hegemony, the ability to shape global economic conditions through their investment decisions rather than through military power or trade policy. The realization was forcing Norway to confront fundamental questions about power, responsibility, and democracy in the 21st century global economy. The debate was led by Trygve Slagsvold Vedum, Norway's finance minister, who had become increasingly concerned about the geopolitical implications of Norway's wealth concentration. We need to ask ourselves, is it appropriate for a single country of 5 million people to have this much influence over the global economy? Vedum argued during a closed parliamentary session, are we using this power responsibly? And what happens if other countries decide they don't want to be subject to Norwegian investment standards? The questions weren't theoretical. Several major economies were beginning to express concern about Norway's growing influence over their domestic markets. China had started restricting Norwegian investments in strategic industries after Norway divested from Chinese companies over human rights concerns. The restrictions weren't just symbolic, they represented the first time a major economy had explicitly pushed back against Norway's ethical investment criteria. Chinese officials argued that Norway was using their economic power to impose Western values on non-Western societies. Norway has 0.07% of the world's population, but claims the right to determine investment standards for 100% of global markets, complained Li Xiaopeng, China's deputy finance minister. In a rare public criticism of Norwegian policy, Russia had completely banned Norwegian capital following their Ukraine-related divestments, calling Norway's fund an instrument of economic warfare, disguised as ethical investing. Even some European allies were questioning whether Norway's ethical investment criteria amounted to economic imperialism. The criticism stung because it contained an uncomfortable grain of truth. Norway's investment decisions were effectively setting global standards for corporate behavior. But Norwegian voters were the only people with any democratic input into those decisions. When Norway required companies in their portfolio to meet certain environmental standards, they were essentially imposing Norwegian environmental preferences on billions of people who had no say in Norwegian elections. When they divested from weapons manufacturers, they were making decisions about global security policy based solely on Norwegian political consensus. The democratic deficit was becoming a source of international tension and domestic soul-searching. Progressive Norwegian politicians worried that they were becoming an unaccountable global elite. Conservative politicians worried that international criticism would force Norway to abandon the ethical standards that made their investment approach distinctive. But the most significant challenge facing Norway wasn't diplomatic, it was mathematical. The fund was growing so large that it was becoming increasingly difficult to invest the money effectively. Norway now owned an average of 1.5% of every publicly traded company in the world. In many smaller markets, they owned 3–5% of total market capitalization. In some Nordic markets, their ownership stakes approached 10% of total market value. Buying more stocks meant either concentrating their holdings in fewer companies, increasing risk, or pushing their ownership stakes above levels that would trigger regulatory restrictions in many countries. Most securities regulations limit foreign ownership to specific percentages to prevent excessive foreign influence over domestic companies. This led to what investment Theorists called the scale paradox. The fund was becoming too successful for its own good. Their wealth was growing faster than global markets could absorb new investment without distorting prices and market dynamics. Dr. Knut Anton Mork, a Norwegian economist who had studied the fund's market impact, published a controversial analysis showing that Norway's continued growth was creating systemic risks for global financial stability. When a single investor owns 1.5% of every stock market in the world, their trading decisions become market-moving events, Mork argued. Norway's quarterly rebalancing now involves buying and selling $100 billion worth of assets. That's larger than the total trading volume of most national stock markets. The analysis revealed a troubling feedback loop. As Norway's fund grew larger, their trading activity had more impact on market prices. This market impact reduced their investment returns, which paradoxically made them buy even more, aggressively to maintain their target returns. Mork calculated that Norway's own trading activity was reducing their annual returns by roughly 0.2%, a seemingly small amount that translated to $3 billion annually in reduced wealth creation. Over decades, this scale drag could cost Norway hundreds of billions in lost returns. Nicolai Tangen's solution was characteristically innovative. Norway would begin investing in assets that didn't exist yet. The strategy involved using Norway's vast capital base to fund the creation of entirely new investment categories. They would finance the development of massive renewable energy projects, fund breakthrough technologies in carbon capture and storage, and invest in infrastructure projects that could reshape global energy systems. Instead of just buying existing assets, Norway would use their wealth to create new assets that aligned with their long-term investment objectives and ethical standards. The approach required a fundamental rethinking of what it meant to be an investor. Traditional investing involved buying shares in existing companies or assets. Norway's new approach involved using their capital to bring new companies and assets into existence. The transformation started with renewable energy. Norway committed $200 billion to fund the development of offshore wind farms that were too large and risky for traditional investors. These weren't investments in existing wind companies. They were investments in wind farms that would only exist because Norway was willing to fund their development. The Dogger Bank wind farm, located in the North Sea between England and Denmark, became the flagship example of Norway's catalytic investing approach. The project would create the largest offshore wind installation in human history, capable of powering 6 million homes with clean electricity. Traditional energy companies had avoided the project because it required $15 billion in upfront investment with uncertain returns over a 25-year timeframe. Norway's fund could afford both the capital requirements and the extended investment horizon. More importantly, Norway structured the investment to align with their broader portfolio strategy. The wind farm would generate electricity that would be sold to European utilities, many of which were also in Norway's investment portfolio. The project would reduce carbon emissions from power generation across Northern Europe, increasing the long-term value of Norway's European real estate holdings. The integrated approach allowed Norway to create investment returns that compounded across multiple asset classes and geographic regions. They weren't just funding renewable energy. They were building an interconnected system of investments that supported each other. The strategy was particularly powerful in emerging technologies where traditional venture capital couldn't provide sufficient funding for truly transformational projects. Norway committed $50 billion to advanced battery development, funding research that could revolutionize energy storage and electric vehicle adoption. Unlike traditional tech investors who needed returns within 5 to 10 years, Norway could fund 20-year research projects that might not generate profits until the 2040s. The patience allowed Norway to fund breakthrough technologies that could reshape entire industries. They were financing solid-state battery research that could make electric vehicles cheaper than gasoline cars. They were funding carbon capture technologies that could remove existing CO2 from the atmosphere. They were investing in artificial intelligence research focused on climate modeling and sustainable agriculture. Most importantly, Norway was doing this at a scale that could actually affect global outcomes. when they committed $30 billion to electric vehicle charging infrastructure across Europe and North America. It solved one of the primary barriers to electric vehicle adoption. When they invested $20 billion in sustainable agriculture technology, it accelerated the development of farming methods that could feed growing populations while reducing environmental impact. Norway was using their investment capital not just to generate returns, but to create the kind of world they wanted to invest in. They were essentially funding the transition to a sustainable economy while positioning themselves to profit from that transition. The most ambitious aspect of Norway's catalytic investing involved infrastructure projects that no single country or company could afford to undertake alone. Norway committed $100 billion to what they called the global energy grid, an interconnected system of renewable energy generation, storage and transmission that would span multiple continents. The project involved underwater cables connecting European wind farms to African solar installations to American hydroelectric systems. The scale was unprecedented. Individual components of the project cost more than most countries spent on infrastructure annually. But Norway could afford to think in terms of global systems rather than national projects. The energy grid would generate returns through electricity sales, but more importantly, it would create a stable global energy market that reduced geopolitical tensions around fossil fuel resources. Countries that currently fought wars over oil reserves could instead cooperate on renewable energy development. Norway was essentially using their wealth to restructure global energy markets in ways that promoted both sustainability and peace. The investment returns were important, but the geopolitical benefits were even more valuable for a small country that depended on international stability. Similar infrastructure investments included high-speed rail networks connecting European cities, fiber optic systems providing global internet connectivity, and water management systems addressing drought and flooding in vulnerable regions. Each project was structured to generate financial returns while creating positive externalities that benefited Norway's broader investment portfolio. The rail networks increased the value of Norway's European real estate holdings. The internet infrastructure supported the digital economy companies in their stock portfolio. The water management systems protected agricultural investments from climate-related risks. However, Norway's expanding influence was generating organized resistance from countries and industries that felt threatened by Norwegian standards. A coalition of oil-producing nations, led by Saudi Arabia and Russia, began coordinating efforts to reduce their dependence on international capital markets that were increasingly influenced by Norwegian preferences. They were developing alternative investment frameworks that prioritized financial returns over environmental considerations. The resistance went beyond just diplomatic protests. Several major economies were actively working to create investment institutions that could compete with Norway's influence. China was developing a massive sovereign wealth fund that would invest according to Chinese rather than Norwegian standards. Several Middle Eastern countries were pooling their oil wealth to create regional investment funds that could rival Norway's global reach. Most concerning for Norway was the emergence of what economists called anti-ESG investment strategies. Some American and European fund managers were marketing investment products specifically designed to avoid the environmental and social criteria that Norway had popularized. These funds argued that ethical investing was reducing returns for ordinary investors, and that Norway's influence was distorting global markets in ways that hurt economic efficiency. They were attracting capital from investors who wanted maximum financial returns without regard for environmental or social impact. The emergence of competing investment philosophies was creating a form of financial Cold War, with different blocks of capital operating according to incompatible principles. Norway's model was spreading to European and some American institutions, while authoritarian countries and resource extraction industries were developing alternative approaches. Norway's response to international criticism involved the most radical expansion of democratic participation in investment management that had ever been attempted. Starting in 2024, Norway began holding annual investment democracy forums where citizens could directly vote on major investment decisions. The forums weren't just consultative. They gave Norwegian voters binding authority over fund strategy in areas where democratic input was feasible. The first forum addressed whether Norway should increase their investments in space technology and satellite systems. The question involved both technical, financial analysis and broader questions about Norway's role in space exploration and satellite-based internet services. Over 60% of eligible Norwegian voters participated in the forum, which included months of public education about space industry economics, technical presentations from aerospace companies, and debates about the geopolitical implications of satellite technology. The process was unprecedented in the history of sovereign wealth management. Never before had ordinary citizens been given direct democratic control over investment decisions involving hundreds of billions of dollars. The results were remarkable. Norwegian voters demonstrated sophisticated understanding of complex financial and technical issues when given adequate information and time for deliberation. Their investment decisions were more long-term oriented than typical political decisions, and they showed strong support for investments that aligned with Norwegian values, even when those investments might generate lower short-term returns. The democratic innovation was being studied by political scientists and economists worldwide as a potential model for democratic control over large-scale capital allocation. If successful, it could provide a template for making institutional investing more democratically accountable. By late 2024, Norway's investment strategy was entering what Tangen called Phase 3 of their evolution. Phase 1 had been building the fund through oil revenues and basic index investing. Phase 2 had involved active ownership and ethical screening. Phase 3 would involve using their capital to reshape global economic systems. The transition required Norway to think beyond traditional categories of investing. They were no longer just buying existing assets or even creating new assets. They were funding the development of entirely new economic frameworks that could address global challenges that markets and governments couldn't solve individually. Climate change was the obvious example, but Norway was applying similar thinking to global health, education, and technological development. They were funding research into pandemic preparedness that could prevent future COVID-style disruptions. They were investing in educational technologies that could provide high-quality education to underserved populations globally. Most ambitiously, they were exploring investments in space-based solar power that could provide clean energy at scales that terrestrial renewable energy couldn't match. The projects would require decades of development and hundreds of billions in investment, but they could eventually provide unlimited clean energy for Earth's growing population. The ultimate question facing Norway was whether their model of ethical capitalism could scale to manage the even larger amounts of wealth they would accumulate over the coming decades. Current projections suggested the fund could reach $3 trillion by 2035 and $5 trillion by 2050. At $5 trillion, Norway would own roughly 3% of all global financial assets. Their investment decisions would effectively determine global economic policy in ways that no democratic institution had ever contemplated. The mathematical reality was sobering. Norway's fund was growing faster than the global economy, which meant their relative influence was increasing exponentially. Without intervention, Norway could theoretically own meaningful stakes in every valuable asset on Earth within a century. This led to serious discussion about whether Norway should voluntarily limit the fund's growth or begin distributing wealth directly to Norwegian citizens rather than continuing to accumulate capital indefinitely. The debate reflected deeper questions about the sustainability of extreme wealth concentration, even when that wealth was managed according to democratic and ethical principles. Could any institution, no matter how well-intentioned, responsibly manage amounts of capital that exceeded the economic output of entire continents? Norway's success had created problems that no country in human history had ever faced. They had built the most successful wealth management system ever devised, but success was creating challenges that threatened the very principles that had made success possible. The next decade would determine whether Norway could solve the problems created by their own success, or whether they would become a cautionary tale about the limits of institutional investing at global scale. The little oil fund that had started as a way to save money for Norwegian fishermen's grandchildren had become something unprecedented, a financial institution powerful enough to reshape global civilization. Whether that power would be used wisely remained the trillion-dollar question that would define the 21st century. So we've seen how a small country with fewer people than South Carolina built the largest investment fund in human history, how they turned oil wealth into a $1.5 trillion empire that owns pieces of virtually every major company on Earth, how they used that wealth to reshape global capitalism according to principles of transparency, sustainability, and democratic accountability. But the real story isn't just about money, it's about choices. Today, 60 years after oil was first discovered in the North Sea, Norway has created something unprecedented, a sustainable model for managing natural resource wealth that benefits not just current citizens but future generations. The fund now generates enough investment income annually to fund Norway's entire government budget while continuing to grow. Norwegian children born today will inherit stakes in Apple, Microsoft, Amazon, and thousands of other companies worth hundreds of thousands of dollars per person. More importantly, Norway has used their wealth to influence global corporate behavior in ways that promote environmental sustainability, social responsibility, and ethical business practices. Companies worldwide have changed their policies to attract and retain Norwegian investment. The scale of this influence is staggering. When Norway divests from an industry, that industry faces pressure from other investors to change their practices. When Norway sets new ethical standards, those standards often become global norms. When Norway invests in breakthrough technologies, those technologies receive the capital needed to scale globally. Yet the Norwegian model also reveals uncomfortable truths about wealth, power, and global inequality. Norway's prosperity was built on extracting finite natural resources that contributed to climate change. Their investment influence allows a country of 5 million people to shape economic policies that affect billions of people who have no say in Norwegian investment decisions. The fund's success raises profound questions about democratic governance in a globally integrated economy. Should any single country have this much influence over global capitalism? Is it sustainable for one nation to accumulate wealth faster than entire continents? These aren't just theoretical concerns. Norway's wealth concentration is accelerating at a pace that could see their fund reach $5 trillion within 30 years. At that scale, Norway would own meaningful stakes in virtually every valuable asset on Earth. But perhaps the most important lesson from Norway's experiment isn't about wealth accumulation, it's about institutional design. Norway succeeded where other oil-rich nations failed because they built institutions designed for long-term thinking rather than short-term political gain. They created transparency mechanisms that made corruption difficult. They established ethical guidelines that were more important than profit maximization. Most importantly, they designed their system to serve future generations rather than just current voters. The principles that guided Norway's success, patient capital deployment, ethical screening, democratic accountability, and sustainable investing, can be applied by other countries and institutions regardless of whether they have oil wealth. The real innovation wasn't discovering oil. It was discovering how to manage wealth responsibly across multiple generations. Today, as countries around the world face challenges that require massive long-term investments, climate change, aging populations, technological disruption, and infrastructure needs, the Norwegian model offers a blueprint for mobilizing capital at the scale needed to address these challenges. Several European countries are already developing sovereign wealth funds based on Norwegian principles. American states are considering similar approaches. Even developing nations are exploring how they might build their own versions of Norway's system. The globalization of the Norwegian model could reshape how humanity addresses collective challenges that no single generation can solve alone. But the model also depends on political stability, social cohesion, and institutional trust that may not exist in other societies. Norway's success reflects not just smart policy design but also cultural values that prioritize collective benefit over individual gain. whether other countries can replicate Norway's institutional approach without also adopting Norwegian cultural values remains an open question. What's certain is that Norway has demonstrated something profound about human potential. They've proven that it's possible to build vast wealth while maintaining democratic governance, environmental responsibility, and social cohesion. They've shown that patient capital deployed at massive scale can solve problems that markets and governments couldn't address individually. They've created a form of capitalism that prioritizes sustainability over extraction, transparency over secrecy, and long-term value creation over short-term profit maximization. Most importantly, they've proven that small countries can have enormous influence when they're willing to think in centuries rather than election cycles. The fund that started as a way to save Norway's oil money for future generations has become a demonstration of how humanity might manage shared resources and collective challenges in the 21st century. Whether we learn from their example may determine whether future generations inherit a world shaped by short-term thinking and zero-sum competition, or one built on long-term planning and sustainable prosperity. Norway's $1.5 trillion secret isn't really about oil or investing, or even money. It's about having the patience to plant trees whose shade you'll never enjoy, and the wisdom to build institutions that serve people who haven't been born yet. In a world increasingly focused on immediate gratification and quarterly results, Norway chose to optimize for the very long term. The results speak for themselves. If you made it through this entire deep dive into Norway's incredible wealth-building strategy, drop AI in the comments below. I spent weeks researching this story, and what struck me most wasn't just the scale of Norway's success, but how they've managed to build massive wealth while staying true to their values. That's incredibly rare in today's world. The comments on these long-form videos are always fascinating because you all share insights and perspectives I never would have considered. So definitely let me know. Do you think other countries could replicate Norway's model? Or is this something that only worked because of unique Norwegian circumstances? If you're interested in more stories about how small countries punched above their weight economically, you should definitely watch my video about Singapore's transformation from a tiny fishing village to one of the richest cities in the world. The strategies Singapore used were completely different from Norway's approach, but equally brilliant in their own way. And obviously, if you enjoyed this deep dive into economic strategy and want more content like this, subscribing really helps the channel grow. These research-heavy videos take forever to produce, but they're incredibly satisfying to make when I know there's an audience that appreciates the depth. Thanks for watching, and I'll see you in the next one.